Go. Hello, everybody. My name's Drew Demon, and I'm the Devil Stockbroker. This is going to be a Monday market recap. Let's go take a look at what the market did today. As you can see by the market heat map, it did a whole lot of pain. Right now, tech sector is retreating fast, along with the energy sector, just as expected. So we're seeing a whole market-wide retreat. The only stocks that seem to do relatively well was Amazon, which is moving into its pre-earnings momentum, and Pfizer, which was up just under 1% today. All in all, the whole market was pretty much red. A lot of other stocks had some green opens in some unexpected sectors. Tesla actually came back a little bit and then gave up some of its gains towards the end of the day. We're going to go take a look at some of the tickers that we have on our list and review what the market may be doing going into the rest of this week. So I mentioned in my previous video that the SPY was behaving in a way that indicated that there could be some continuation or there may be some very sharp pullback. So far, today looks like we're getting the very first big pullback. Doing a little bit of fib retracement drawing here on SPY. I'm analyzing what it looks like our resistance is at, which is pretty much dead center on the 200 period daily EMA. The fib retracement shows that there is support here on the 23 fib level. If we get a bounce here in the SPY at any point this week, or if we just chop sideways in this area and manage to come back, then I would assume this means continuation for the duration of December and the Santa rally. This is going to play out over the rest of the week, so we need to see what the next Tuesday, Wednesday looks like. And if we continue to see bullishness going into the end of this week, then assume this is confirmation of the December rally, and we'll see some more upside. I'm essentially targeting 410 as our first real line of resistance. 410 is a significant area because this is at the top of a bull channel that the market has drawn over time. So 410 is significant because it is the top of this megaphone pattern, which the SPY has been respecting this on 3 consecutive touches during its bear market rallies. So if we do get a touch of 410, this is where I will start thinking about getting into some short positions for next year. This is going to be a really tough swing, though, because we have a lot of bullish factors going into this next month. For one, we have the FOMC decision that's coming from the Fed. The market is pricing in a 50 basis point hike, which is a little bit less than what they have been trending towards. Typically, they've been doing 75-point hikes for the majority of the year. So a 50 basis point hike would be considered a, quote, slowdown. This is what the banks are pretty much hoping for in order to get some relief in the market and allow the market to kind of run a little bit longer. But if this is already priced into the market by the time we get to these price levels, then this could indicate a very rapid turnaround on the release of that news. It's kind of a buy the rumor, sell the news situation where everybody is hoping for that 50 basis point hike, and therefore that's how they're placing their bets accordingly. And that is what's driving the market. If the market does end up getting to 410 or possibly even overextends itself to 420, which I do consider a distant possibility, but less likely. However, if we get some sideways chop or some downside going into FOMC, then once the decision is made and we see the 50 basis point hike, then we may get a delayed rally in the back half of December going into New Year's. So this market can chop in this area pretty unexpectedly. It's going to be difficult to read the market, but I've got a few other indicators to look at so that we can kind of account for both scenarios. For starters, I have ascending wedges that have formed on the RSI. If you look at the ascending wedge on this RSI, you can see that once it broke below, there was a very clear breakout that occurred at the top of the market, and there was plenty of days to give you time to switch into bearish mode, especially when you compare this to HYG, which we'll do in just a minute. So right now, this ascending wedge is still forming. We are at the floor of it, but I am somewhat expecting for a market bounce back to the top. So if we do end up getting that bounce and the RSI continues to form out this ascending wedge, then I assume that this will create a much taller ascending wedge on the SPY. That is to say, on the price action. So once we get more of this pattern formed out, then as we get closer and closer to the tip of the wedge, that is where I will start looking for weakness in the market to move into short positions. Right now, the market hasn't moved enough for me to consider this anything but consolidation. If you caught this top and bet to the short side and won during the day, congratulations. I know a lot of Hell's Trading Floor did really phenomenally this Monday, taking 0 day to expiration puts on the SPY. So shout out to you guys. It was an excellent series of trades. We've got a few other tickers to look at, but before we move on to those, I'm going to go and look at SPY over HYG. Here is the SPY HYG ratio chart. And right now we are starting to see bearish divergence and a crossover on the MACD. So this indicates to us that the momentum in the SPY is starting to demonstrate weakness as the HYG is not agreeing. So part of what tells us this is that we've had this ascending wedge forming on HYG, somewhat of a channel, but notice that HYG moved down a lot more strongly than the SPY moved down today. Given that both of these are moving down together, I'm seeing that they're both agreeing with each other, and I do expect a bounce going into the second half of this week. But this is where we start seeing weakness in the market, and we need to start being really careful. Specifically, we have our first bearish divergence on the SPY, where the SPY has created a higher high in the price action and a lower high in the RSI. So this tells us that there is continued weakness and the MACD agrees with it. So this is a classic topping formation that we need to be aware of. If we see continued weakness and the indicators start to trend towards the bearish side of the trade, then we're going to switch to bearish swings all the way out until 30, 45, 60 days. So that trade isn't happening yet. We don't have confirmation. We are still waiting. It's a bit early to tell yet. So we're going to switch over to the Qs and the Dow Jones, which when this is moving up, when you see this ratio chart moving to the upside, this is generally an indicator that risk-on sector stocks like technology are doing very well as opposed to industrials. And when you see it moving down, that means that industrials are outperforming risk-on sectors. So this is kind of a risk versus defense ratio chart. And here I have the Qs and the Dow Jones Industrial Average by themselves. So up here is the ratio chart. This is the Qs, and here is the Dow Jones Industrial Average. So looking at each of these, we can see some pretty dramatic performance out of the Dow Jones Industrial Average, considering that this is largely made up of industrial defensive sectors, producers, and consumer staples. This is pretty unusual activity. And actually, what it indicates to us is that the market is in a very protective state. Everybody is trying to shuffle their money into places where they are going to experience the least amount of pain, while the Qs are starting to put in lower highs and are flagging, while Dow Jones is continuing to move up in a ascending ascending wedge, but still moving to the upside. Eventually, when bear market momentum takes over again and we move into that shorting phase once again, we are going to see sell-offs in all of these sectors, but it's just a matter of which one is going to hurt the most first and when is it going to happen. So these divergences kind of do tell us a little bit of that story. We've been seeing crossovers to the upside, which indicate that there is a little bit of bullish momentum to the tech sector. We've seen them getting bid up for the most part as of the last several weeks. I'd say even as far as a month ago. And generally the SPY agrees. But the Dow Jones outperforming the industrial risk sector really does tell a story that that nobody is really betting on those risky assets anymore. And what is pushing the SPY to the upside is all defensive plays. One particular stock that I'm going to take a look at that's been doing extremely well lately, uncharacteristically well for this market, is Netflix. And right now, Netflix is just about ready to finish filling a gap. So here we have this big gap that has formed on Netflix that you see highlighted here on the left. It's created two higher highs and had two crossovers on the MACD that were both bearish. We've also had a bearish divergence on the RSI. Now, initially, this might entice somebody to take a short trade on it right away. I'm not doing that just yet because I've seen that the stock caught itself at the 61% retracement level on the fib. This is a bullish setup for the stock to catch itself, and I expect it to go for one more high. This will actually create an ascending wedge, which not a lot of people are seeing right now, I can promise you. Most people are not seeing an ascending wedge right here, but it is beginning to form. So if you're following this, what you should see is that the price is beginning to oscillate around the 200 period EMA, and it is forming higher highs and higher lows. We would expect this to hit one more low right here at the bottom of this wedge, form a floor here, probably somewhere around 275, and this will be perfectly on the 62% retracement level for the fib from this low to high. Now, when it bounces off of this level, it can bounce extremely aggressively, move up to the upside, and complete this gap fill. Once this gap fill is completed and it reaches this new higher price, I anticipate that Netflix will sell off very, very hard. This is an area that Netflix, in my personal opinion, doesn't deserve to be in because its price to earnings ratio is so high still, even after selling off as far as it has. And their performance still does not demonstrate continued growth at the pace that they've been promising. And the market has been betting on Netflix this entire time, even during this bear market, believing that it would continue growing at the pace that it did during the COVID pandemic, which is just, it's outside the realm of reality. So when reality does eventually set in, or if it hasn't, if it has already, I'm assuming it actually has for some of the institutions at the very least, if they get this price up to 320 or 335, anywhere in this range is where we're going to start to experience a last spectacular sell-off in Netflix, and we'll start seeing a dramatic fall from grace. And it'll be very similar to what we saw during December, January 2022 when Netflix dropped from $500 all the way down to $280. So Netflix still has a long way to go for this trade setup to be complete. In the short term, it does look like it has set up a nice floor where it can create a double bottom here. So watch this very closely. Keep an eye out for this bottoming formation to complete. So if you get any double bottom candle and a bounce, V-shaped recovery here, you can catch this trade to the long side and ride it all the way back up to that 200 period EMA on, I would say, a 15 to 30 day swing. And then continue playing that to the upside until Netflix eventually finishes filling its gap. It does have that potential to finally complete that formation, especially if we do get the Santa rally that we're hoping for. At the end of that, though, expect Netflix to pull back very hard, very quickly. The other trade that I'm also spotting is Nvidia, which is part of the semiconductors. It's been doing a little bit better after releasing an extremely negative earnings report that promises that they are essentially spending way too much money. This triangle, to me, while it does read as a bullish symmetrical triangle, I expect to fail because they never reached their 200 period EMA and got promptly rejected with this evening star. Now they have set up a new lower high on the price action. The RSI is pulling back hard. After one more bounce here, I expect for it to double top and then crash. And that will form out the last high for Nvidia in the next 3 months. So those are what the technicals read to me. Nvidia, in order to invalidate this thesis, would need to break and hold the 200 EMA above $170, and it would need to consistently hold that level for at least several weeks for me to be convinced that Nvidia is not worthy of a short. Right now, just to give you a little bit of an idea of the fundamentals, they're pouring a whole bunch of money into quantum computing and data center technology, which, in my opinion, is a sector that's starting to see businesses retreat from as they're cutting costs. And their gaming GPU sales are just terrible right now. So, with all of that being considered, I think that Nvidia is going to start hemorrhaging money way faster than they can replenish it, and they will need to start eventually taking on debt in order to shore up their balance sheet and maintain a heavy cash position so that they can take advantage of market opportunities going into the future. This is going to require them to start selling bonds, laying off their employees, and doing anything that they can to cut costs, which may eat into their whole hype campaign surrounding this quantum computing partnership that they've established with Microsoft. Overall, where I see Nvidia going to by the end of this bear market is all the way down to $90. I believe that it could reach this location by some point up till around May or June of next year. So this is where I see Nvidia going to over the long term. In the near term, Nvidia is going to bounce over the next week, maybe 2 weeks. And then once we see that weakness, I'll be taking a short trade to ride it down over the next 3 to 4 months. Okay, moving on to Apple. I've got, we ended up being way more right on this trade than I expected to be. Apple gapped down really hard after the riot news that came out that I spoke on over the weekend. Apple is currently down by about, let's measure this out from the Friday close. They are down a total of 2.5% from Friday's close. So Apple's not in really great shape, and this actually forms out the top of a diamond bottom pattern. So, Apple, in trading over the course of this last, let's say 2 months or so, it's formed out this diamond bottom pattern, which it has to fill out this final shoulder, which means that it needs to touch the bottom of the diamond pattern. Now, I mentioned this as being the first take profit, which if you already took the trade first thing in the morning, when Apple made its run to the upside and took the short bet, then you should have already had a take profit and made a big killing on this one. But we have a second take profit down here at 137.95. You could just round this one up to 138 if you like, but this is where the candles are sitting at anyway. So this is a this is a critical moment for Apple. There's two possibilities. It can either keep crashing down to this level and it can bounce off of the bottom of this diamond, or it can chop its way and try to fight for the top and then cut down through the bottom. So those are the two possibilities that I see with Apple. If it does end up coming down very quickly and then bouncing off of the bottom of this diamond, Apple can go on a very rapid run for the Santa rally. This is strictly based on the diamond bottom pattern. Now, on the other hand, if Apple ends up getting even worse news, fundamentals will overtake technicals in this market. And if we have a situation where Apple starts losing massively on inventory, starts giving up a whole bunch of sales just by not being able to meet the demand for their new iPhone because of the riots going on in their Chinese manufacturing facilities, that could spell massive disaster for Apple. And that's a loss that they can't really tolerate right now because Apple just took on a huge sum of debt by selling its bonds. And I have little doubt that if their sales season this year is a massive disappointment, it will easily lead to a massive drop in their stock's value. We're going to have to stay really, really close to this problem. More important than the technicals for Apple is going to be what the response is by the Chinese Communist Party in China in response to the riots and the zero COVID policy. If Apple doesn't get its facilities back up fast, they're going to make some huge losses and create a big gap in their cash flow for next earnings, which this is their most bullish earnings season ever. Any year, any time of the year, this is the best. If this is terrible, if this Q4 earnings is awful, it will ruin their outlook for the next year. So pay very close attention to that information, the news on the riots. You can track this in TradingView. It's all over the news. And if you don't already have TradingView, this is your chance to get it. They're running a 60% off special. You can click my affiliate link in the description of this video and sign up for TradingView for 60% off on a yearly subscription of their professional plan. And we're going to go ahead and wrap up with Amazon now. So Amazon is starting to see just a little bit of strength in its chart coming back for earnings. The expectation for Amazon as of its previous earnings was not so great. They had a really terrible outlook, and they disappointed massively on revenue. They had several downgrades and still weren't able to meet their revenue expectations. So because of the disappointment there, on top of the repeated revisions to their earnings expectations, Amazon took a heavy hit after earnings. We're now starting to see the stock begin to bear flag back up. And if we do end up forming this bear flag to completion, then we can expect some upside in the short term. But in the long term, especially going into the holiday season, when they report in February, unless their sales are just absolutely stellar, which I don't expect them to be, then Amazon still has farther to go to the downside. So we're going to stay really close to this one also. For the short term, Amazon does seem to be fighting for air and getting a little bit of strength. If we see that this bullish cross is confirmed with a cross on the RSI above this moving average line, then that would confirm a buy signal for me from Amazon. A little bonus if the volume direction candles give it a very strong candle that crosses through this fast moving average line. If I get all of those signals together, then that would be a long signal trade for Amazon for me, and I would probably swing that only maybe a week at a time and probably look to take profit as often as possible, because this is a very volatile one right now. Amazon's chopping up and down, and there's a lot of whipsawing going on in the market overall. So keep this one really close to the chest and keep your trades short term and as little cost as possible, and only trade this one for a few days or a week at a time, because things can turn around really quickly. Be ready to pivot on a moment's notice. That's going to do it for this video. I want to thank you guys so much for watching. If you like the content and you found this information helpful, please be sure to leave a like. It helps out the YouTube algorithm and helps us get this information to everybody who wants to see it. Also, consider subscribing and hit the bell icon so you get notified whenever we release a new video or open up a stream. And if you are interested in learning how to trade the market, whether you're a day trader, swing trader, somebody new, or a veteran, Hell's Trading Floor is always open to anybody from all walks of life who is interested in learning more and leveling up their trading capabilities. Consider joining us at hellstradingfloor.com, where you can join our Discord at discord.gg/hellstradingfloor. Thank you guys so much for watching, and I will see you next time. Until then, have a hell of a time in the markets.